Welcome back to another episode on investing and investment. This is Dr. Suzy Puplampu, the CEO of OctaneDC. In this episode, I would like to conclude on the conversation on three major considerations we must make in making investment decisions. In my earlier episode, we examined age and investment objectives. We would like to look at what we call risk profile. Each of us is defined within a certain risk profile when it comes to investing. For every investment decision we must make, it is very important that we understand the underlying risk involved in the investment. Following our risk profiles informs the type and the choice of investment instruments we must invest in. So the question is, how do we know our risk profile? This is very easy. We need to take an investment risk assessment. There are general questions that will be asked by a financial advisor to determine our risk profile. Your responses will definitely help to know your level of risk appetite when it comes to investing. Now let's look at risk profile in detail. Risk simply means the chance that our expectations on investment returns differs from the actual returns. Risk profile, like any other defining factors, is classified into three broad areas. Let's start with what we call the low risk profile, when you are described as somebody with low risk. With a low risk strategy to your investment, the perception is that there is a low chance of you losing your capital. With such a profile, you are unable to invest in any financial asset that cannot guarantee you returns. So the recommendation here is what government papers such as treasury bills and government bonds. The choice of investment instruments in this group should be in one that can guarantee you some steady growth and will not suddenly drop in terms of value to affect your capital. So your choice of investment instruments, if you find yourself in this group, should be assets that can guarantee you steady growth and will not suddenly drop in terms of value and affect your capital. Let's go on to examine the medium risk, where you find yourself in this group where you are described as somebody who can take medium risk. This strategy calls for moderate returns with moderate risk. With this profile, you are ready to take on any surprises that may come along the way in the medium term, such as 5 years. You are also ready to pay some price for the medium risks that you are prepared to take to receive some significant gains on your investments. What are the choices of financial instruments in this group? We can look at properties with some high yielding rental incomes. We can also look at equity mutual funds, and we can also consider private equity funds, which pool funds from a number of private investors for investment in other ventures. Now the very last group, which is the high risk profile. With this strategy, you are prepared to lose all of your principal. Yes, you must be prepared to lose all of your principal. In other words, there is a high probability that your entire investment could be lost. But how do we mitigate this fear in losing our entire investment? The strategy is in diversification. Dear friends, we must consider the following: that there's a trade-off between risk and return. And we must remember that there's a greater loss for us in missed opportunities rather than actual losses on investments. The loss is reflected in us not making a decision to do nothing at all. In our investment decisions, we must remember, are influenced by our financial literacy levels and income levels. So it is good to receive enough information before we take investment decisions. If you like our channel on investing and investment, please subscribe and put on your notification alarm and keep following us. Thank you.